Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to the Credit Clubhouse podcast. As always, I'm your host, Todd Anderson, head of content and programming at Deal Catalyst. Joining me today is Joel Holsinger, partner, portfolio manager, and co-head of alternative credit at Ares. Joel, great to see you. Thank you very much for your time. Looking forward to our conversation.
Thank you for having me on the podcast. I greatly appreciate it.
Of course. So to kick off, I know we're going to talk a lot about ABF, fund finance today. At Ares, since it feels like a lot of people I talk to on this episode might have a different definition, how would you define ABF and kind of where would you draw the lines between specialty finance, structured credit, and private asset-backed lending?
Yeah, if you look at it at Ares, everything we do asset-based finance is a portfolio. And so if you look at it, everything's a portfolio. It's a portfolio of loans, leases, receivables, royalties, or otherwise known as contractual cash flows. Contractual cash flows that are coming from a corporate or from a consumer in some form or fashion. And the way I look at it is the broader world of ABF, you can kind of divide into two sections. Some set things I know we'll cover later. One is the asset-backed securitization market. That's the liquid part of our market, which is where a lot of your insurance and others will play. And then there's effectively the non-IG or non-insurance part of the market where you're kind of doing direct transactions, direct sourcing. Frankly, it's no different than what you think of when you think of the corporate market from the standpoint of fixed income and leverage lending. Is effectively the liquid part of the market, and then the direct lending is where you play kind of on the illiquid or direct sourcing.
So ABF has clearly taken off the last few years. Some would say it's gone from niche to mainstream. Kind of what are maybe some of the key drivers behind this institutional embrace of these strategies?
Yeah, it's interesting. I think the narrative sometimes, is a little bit off from the standpoint of, on one side, it's a $30 trillion market, but it's been a massive market forever. It's not like everybody woke up one day and said, wow, there's this $30 trillion market that we never knew actually existed. You really have to go back and, for anybody who follows our In the Gaps newsletter or some of the stuff I put out, I'm a big reader in history and a geek when it comes to the history of finance and history generally. And if you take a step back, look, this is my 29th year of doing this. I came out of college in 1997 and I worked for Citigroup. And I did a lot of the same kind of assets and things that we do today. It's just that it happened to be put on a bank balance sheet.
Yep.
And so it's just exactly the same in direct lending. The stuff that's done today and what we call direct lending, everybody talks about it like it's this new asset class or new private credit. The only difference is it's the same assets getting done it used to be on a bank's balance sheet. Now it's not on a bank's balance sheet. But really, that's the larger transformation of finance. If you go back 10,000 years of kind of written history, all the way till the last 50 years, everything was banks,
Yep.
banks, and banks. And then, the securitization market started at its kind of earlier stage in the 1970s. Insurance obviously started before that, but it was really just done for trade finance and other things until really the growth of the asset-backed securitization market. And then obviously you've seen the growth of private credit, you've seen the growth of pension funds, you've seen it. So now instead of having one pillar, there's five pillars. And the reason that's really important when you talk about ABF is, you really have to draw a line at pre-GFC, post-GFC. Not too different in private credit, but for totally different reasons. When you think of, direct lending from that standpoint, it was the commercial side of the banks. And then it went to effectively the direct lenders and others, including Ares, obviously, is one of the largest established players.
Mm-hmm.
But if you look at it from an asset-based finance standpoint, it was really pretty consolidated. There were 6 or 7 really large players, and then there was a number of players underneath that. And the large players were your prop desks of banks. It wasn't the commercial side of banks. It was Goldman, it was Deutsche Bank, it was RBC, it was Citi Alternatives. It was those groups that dominated that market with their low cost of capital. And then the thing that's forgotten on it most of the time is the commercial paper players. GE Capital, CIT, and Capital Source. And GE Capital was bigger than anybody.
Yep.
When it came to what we call ABF today, if you look at every asset class we invest in ABF, GE Capital owned or lent against it. Equipment leasing, small ticket, large ticket, aircraft leasing, rail, rail car, shipping containers, you name it, credit cards, consumer, they had every bit of it all inside of GE Capital. And they had an even lower cost of financing than banks with commercial paper. And arguably the only liability that was a worse matched liability than banks was the commercial paper market. 30-day paper on liability as opposed to deposits and some longer term CDs and other things. And so everything changed post GFC. And so, if you look at Ares, this is our 15th year of asset-based finance or alternative credit at Ares. Really, it goes back further because the predecessor firm goes back to 2006 that was acquired by Ares in 2011. But this is the 15th year. The thing that's interesting is most of what happened was you went from very large consolidated 7 or 8 players to very fragmented because all of those people who left those groups started an aircraft leasing group, started a litigation finance, started consumer, and started those things. And there's been this reconsolidation where, especially in the last 5 years, Ares being one of the largest, reconsolidating that market, both across the insurance products as well as across the non-insurance side of that market.
So when you referenced obviously insurance there, what are the types of LPs that are most attracted to ABF? Is it the insurer, pensions, wealth channels? Maybe talk a little bit about the LP perspective.
Yeah, I'd say right now it's less on the wealth side, even though there's a couple newer funds that some peers and others have gone in there. Most of the interest has been institutional, but you really have to divide the line institutionally to insurance and non-insurance. About half of our AUM is what we call IG solutions, which is insurance. Most of that is insurance capital, whether it be through Aspida or whether it be through other third-party insurance managers or others that we have accounts with. And then the other is the non-IG side, which is effectively what we call our kind of Pathfinder family of funds, which is across a couple of different fund series. And if you look at that, the thing that's interesting is that's Ares where it's about 50-50 and it's kind of insurance, non-insurance. But if you look at the larger players, if you look at the insurance side, some of our larger peers have gone all in on insurance and honestly have nothing or limited on the non-insurance side. So they've really done it more towards their captive insurance platforms where they own 100% or so. And they've scaled up the insurance capital. But the thing that's forgotten in insurance is it's got to be IG. 90% plus of it needs to be IG. And that really is something that's rating agency dependent and regulatory dependent and structured into that portion. There's a huge other world, call it a third of the 30 trillion, that is non-insurance. And that's where, if you think of the insurance, what you're doing there, whether it's buying the ABS market or whether you're doing private IG where you're getting it privately rated, which is just a publicly rated deal done on a private rated basis. There's nothing, nefarious about it.
Yeah.
When you look at that side of that market, that's really a fixed income type of a market. It's a beta plus. You are taking the spread or the fees that a banker used to pay and putting them into the spread. Whereas the alpha really kind of often comes from more that generation, that sourcing, the same things that you see across private equity, across direct lending, across other parts of alternatives.
You referenced the captive insurance platforms. You know, when you think about maybe some of the different models emerging, in this space, you have obviously the captive, which you just referenced, and I did strategic partnerships, and then you got the pure investing and the asset management mandates. How do you think about some of the trade offs between these different models?
We have a different approach. Many have touted their captive model. We don't want to be captive to a model. We do believe in relative value, and we look at it as whether you're investing across IG solutions for insurance or whether you're investing across the rest. The real key is to be nimble because, if you look at this area, as much as it's a large world, nothing stays interesting for 5 years. Some things stay interesting for 3 months, some things stay interesting for 3 years, but there's a pivoting that occurs. There's this, as I jokingly say, the only thing that economists get right, or only thing where they're not just weather forecasting, is supply and demand. It's the one rule that works, it's the one law. And if you think of the supply and demand, it works because what happens is relative value becomes very uninteresting in certain asset classes. We've seen this and we wrote a white paper even talking about this, which is, a little buyer beware on significant risk transfers. You got to be really careful where you play there right now.
Yeah.
As much as there was a great opportunity 2 years ago, what's happened is the risk has gotten worse and the pricing has gotten worse. And so if you just stay in that area, or even worse, what used to happen, raise a niche fund that's all it does, you're kind of playing in an area where it's offsides and that area is there. So
Yeah.
the thing on captives is those who generally do captives are doing them to feed their insurance platforms. And that's a very different approach. You might be willing to buy something at a big premium to book value because you say, oh, I can grow the ROE over here on my insurance platform. We're never making investments that aren't just great investments on the underlying fundamental relative value, having nothing to do with regards to insurance or where it's going or other pieces. It's always find great risk and be a preferred counterparty. And so I think the danger of the captives is what happens when the relative value starts to suck in that thing that's your captive. And you
Yeah.
have a whole bunch of people looking at you. For us, we just pivot to other areas. We rotate. If you're too captive to that model, you're still going to have this alignment issue of where do you actually originate into and how do you keep that platform going, hoping that that market comes back and relative value gets more interesting.
When it comes to innovation, right now, do you see more at, the asset level, the fund level, the financing level? Maybe think about those three pieces and what you're seeing in terms of, innovation, whether it be structuring or any other innovation you might be seeing.
Yeah, I mean, innovation can be good and it can be bad, so it depends on the use of the word right now.
Yeah.
I think when you think of innovation from that standpoint, there's some things that are great innovations on fund structures that make better structures with regards to alignment with LPs and the underlying investments. We've been very careful in the way we've crafted some of the stuff we've done to make sure that we are matched. We are not sitting there taking, asset liability mismatch issues. We are trying to make sure that our fund lives well extend beyond the assets. And so the end, you never have a pressure, you never have forced selling, you never have any of those issues that come through that. So I think some of those innovations are important because, I always like to make the comparison when you think of and I've said this in a prior podcast, which is, there's the liquid market and there's the illiquid market. And those who play in the liquid market, the asset-backed securitization market, or you could say the same thing in leveraged loans or fixed income, they're food critics. When you think about what we
Yeah.
do on origination of assets and direct sourcing, we're chefs. We're sitting there, we're building the menu, we're buying the ingredients, we're putting it together, we own it from beginning to end, and there's no just punching or selling or other things. You need to make sure it. And when you think of that, it means that the fund structure is your kitchen. And from that standpoint, you're only as good as your kitchen, right? You need to make sure you structure something that matches the assets, both on return spectrum as well as fund life, and making sure that all those things are there. So I think we've seen good innovation there to make sure, because I actually think some of the niche funds were bad ideas. And if you look at it across asset-based finance, look, there's really only us and three others that really have a 10-year plus track record across this space of dedicated funds. It's not that people haven't been doing it. They were either doing it within portions of funds, but as one of the largest consolidators or reconsolidators of this space, you also have to be careful of bad innovations. So what scares me? The scary side of innovations is in many ways insurance, which is too much of a good thing. If you think of it, what's the good side of insurance unlike banks? If I talked earlier about the 4 or 5 different pillars of if you're a sovereign and you want to grow your economy, how do you do that? And your money multiplier, we talked about those. It's the asset-backed securitization, it's banks, it's insurance companies, it's private credit, it's pensions. Well, in that same vein, everybody's matched beyond one. Banks.
Yeah.
Systematic risk always sits in banks, period. Because if you go back, it's hard to remember that only 3 years ago, we had 3 of the 4 largest failures of banks ever in the history of the United States for 3
Yep.
perfectly healthy banks where the assets were fine. It was just a run on the bank that effectively created that. So banks are always mismatched. And if you think of LTCM, it wasn't a bailout of a hedge fund, it was a bailout of a bank. If you think of the LDIs that occurred in 2021, it was banks that had too much leverage on the underlying. If you think of the GFC, it's because banks always over leverage into a liquid asset and have mismatched funding on assets and liability. Insurance, the good side is, especially if you go to annuity, is on the insurance side, you have match funding. You're issuing a 3, 5, 7, 10-year annuity. You're matching it to the assets. The only thing you have to be careful of is not all assets are created equal. If you buy residential mortgages, the good side is you're matched on your duration, but anybody who's played in this investment for a long time, there's duration and there's duration. If rates go down, your prepayment rates are going to go way up and your duration is going to shorten.
Yeah.
Why did 2 of the banks fail? They failed because of AOCI, reported losses, which weren't real losses, was mark to market, because they'd gone on the other side of it. They had low rates on Freddie and Fannie mortgages, the healthiest assets in the world, and all of a sudden the duration went from 5 years to 12 years because the prepayments dropped when rates went up.
Yeah.
And so you do have to be careful with regards to insurance on 2 things. One, ALMs match, but they can change on duration. But then 2, money flows in and it does need to match. It does need to go out. And the one thing you have to be careful of, and we've talked about this in the gaps, is that feedback loop of forced buying. Money comes in and you got to put it to work. It's hot potato money. And I think the thing that gets a little scary is we've seen some tests of things, the Warren Buffett, you see who's naked when the tide goes out. We've seen some nudity on the beach. We've seen some fraud. We've seen some other issues, and there hasn't been a tide coming out. But a lot of that is you got to watch the supply demand. You got to watch the flows. You got to watch a lot of it driven by the liquid market and the bank market kind of going when you are later stage and going after those assets and driving that. And that innovation is the part you have to be careful with. And people think, frankly, getting things rated that I didn't think were rateable.
Fund finance, which we're going to delve into here. Are ABF and fund finance converging? And I guess a side question to that while answering, we recently did a survey that'll come out in the next few weeks where the final question we asked was, is fund finance a part of another strategy or is it becoming a strategy unto itself? And it was pretty split, but it was majority of people that answered did say fund finance was becoming a strategy unto itself. And so do you guys see that as a trend? Is it part of ABF? How do you view the fund finance market?
I see it as part of ABF. Everything's a portfolio, loans, leases, receivables, underlying, and everything you do in fund finance, whether it's a subline, capital call line, GP structure, CFOs, rated note feeders, they're all part of that. They're just different forms of it on what the underlying assets are. Obviously, you have to be careful what the underlying assets are, and it kind of goes to all things. What's the advantage we have in asset-based finance versus even corporates? We have no single name risk, right? You're looking at everything's diversified. A portfolio can be 5 positions. It can be 500,000 positions. Yeah. You get that diversity. You get that portfolio theory. You get that same advantage in fund finance, but you still need to go do the work on the underlying because I can have highly leveraged underlying private equity pieces. But in the end, if I'm advancing a very low advance rate against them and I have a ton of them, you're okay. Right? Like you can, but you have to do the work on how much leverage is on the underlying companies. what's the underlying valuations, what's that underlying piece. But I look at it as it's definitely a subsegment of asset-based finance. And it's just like what I said 29 years ago back at Citi, which is, if you go back 29 years ago back at Citi, it's the same thing. If you go back to 2020, we've been doing fund finance deals for 25 years across assets. They're just more sporadic. What changed is in 2020 with some of the Basel in game, especially starting in Europe, it changed the regulatory treatment where a loan that used to getting done at a bank at SOFR plus 300 to SOFR plus 350, all of a sudden was getting equity treatment, and it got kicked out of banks because it was no longer something that worked for them on a risk-weighted asset basis. And they said, oh, wait a minute, the next natural home is private credit. And all of a sudden that stuff that's getting done at 600 over or more on a spread basis, exact same risk. And people sometimes go, well, how can it be the same risk? And I was like, well, it's really simple. Banks are 15 to 20 times leveraged. Private credit is unlevered or maybe 1-to-1 if you go to BDCs or other side of things. So of course, when you go from one to the next, everybody's solving to the same ROEs and return on equity. The difference is the return on equity on one. If your insurance, it's 12 to 15 times leverage. If your banks, you're 15 to 20 times leverage. What is totally underestimated when all of these conversations go around systematic risk and on all the other things, private credit at most is 1-to-1 leverage generally. I mean, you can only be statutory 2-to-1 leverage inside of a BDC, and that's like you can't break that point. So you're never going to get there. Most private credit funds are unlevered. So if you think of that and you go, wait a minute, one has unlevered and one has 15 to 20 times leverage. Well, yeah, of course the returns have to go wider on an unlevered basis when it leaves that regulatory environment of the banks. It's why we call our newsletter In the Gaps. They're in the box. Banks and insurance have to be in the box. We're in the gaps.
So it's when thinking a little bit more about fund finance, obviously it's beyond sublines. You have NAV lending, you have preferred equity, GP financing. Are we in this permanent expansion phase near limits of some of these products? How do you think about the non subscription line products that have obviously taken off the last couple of years?
Some of it's just the growth broadly of the secondaries market. Frankly, if you think of the secondaries market, that was it's like fund finance. We valuation vehicle deals back in 2011, 2012. The difference is they were generally the broken funds. Now it's the clean, good assets. It used to be that was the LPs wanted it out and they didn't care anymore and they were doing things at discounts. The thing that's occurred, and this is a good thing, if you go back in history and anything in finance, if you get rid of friction costs, you trade more and levels are better and you have more liquidity. So the more you actually reduce bid ask, the more things trade. And what you've seen, if you think of the growth of credit secondaries over the last several years, that's an asset class where it used to be as an LP, I'm a pension fund, I'm an endowment. I decide to invest in a private credit fund, and I pretty much am making an investment that I'm assuming I'm staying in for 5 to 7 years. And the assets have to run off and others. Now, if I really wanted to, I could probably sell that for near NAV, high 90s. So that changes the way you even allocate to an asset class, because I would argue that in some ways is more liquid than liquid parts of your portfolio when things have issues. And so when that creates that liquidity, what it does is it creates a whole secondary market that goes with that, which is a good thing long term, because in the end, if you look at it this way, I think Mike Arrighetti, I'm going to get these numbers wrong, our CEO made a great quote, which was, if you're not investing in private credit and private equity and alternatives, you're missing out on like 90% plus of the companies in the world. We're forgetting how small the number of public companies are now. Because they shrink every year and every year and every year. Yep. So you're really investing in this tiny little piece of the market if you're investing in public equities, because they're the only ones that are left. And every year they shrink. It's like banks. Every year there's less of them. Mm-hmm. And so when you think of that world, what do you want? You want liquidity. And liquidity can come through secondaries. It can come through fund finance. There's a lot of ways to create liquidity. And that growth of liquidity, I think, will only continue. Because what it does is it gives people a lot of different options. I can sell my secondary LP portfolio. At the same time, I could finance it as an LP in a secondary basis. At the same time, the individual fund could take out a NAV loan against that. All things within moderation. Clearly, if you go too far down the road or too much leverage. But I think the thing that's been very good in fund finance is if you look at NAV lending, if you look at secondary levels, they've all been done very conservatively, where you're basically taking AAA type risk with regards to the attachment points if you were looking at them versus public transactions. I think the only thing we have to be careful of is as you go into less CFOs, because that same thing applies. They have to be large secondary portfolios. They have to be credit. You can't put a real estate equity into a CFO because it won't rate. It needs to be secondaries and credit. It needs to be diversified. It needs to have credit functions to it. It needs to be relatively invested for those deals to work. Rated note feeders is the area where I do think that you need to be careful that people can't raise capital because they're tied to a large captive insurance company in a fund that frankly their institutional LPs would say, I'm not investing in that fund. That's the only area you have to be careful with is making sure that people are still kind of crossing those same kind of barriers. I think so far the market's taken care of itself, but every once in a while we'll get a deck and we'll go, wow, I don't know that that fund could raise itself without this kind of a structured piece. Generally, the market kind of agrees and says they won't also back it in a rated note feeder structure.
You referenced CFOs or for those not familiar, collateralized fund obligations. What's kind of some of the primary reasons for is it term financing, ratings arbitrage, capital efficiency, something else?
No, I mean, if you think about it, it's a big old portfolio. And so your average CFO is going to be effectively a portfolio of secondaries, whether it be private equity secondaries or credit secondaries, as well as a portfolio of underlying credit funds, underlying normally direct lending type funds and others.
Mm-hmm.
And what it really is a more efficient financing tool, to your point. So there is an appetite, obviously, for the rating and for the spread portion of it. But it also helps with regards to thinking through the fund life of the underlying assets and the growth of the new funds. So you're normally taking some of the existing funds that are anchored and already invested and fully baked and now in harvest mode. And you're normally taking a portion of it into a new fund series and raising it into that piece. Again, all of this creates that additional liquidity in the market, whether it be through secondary, whether it be through the financing, that frankly makes it more attractive versus, if you say if you talk about the illiquidity premium, I would argue you should have a liquidity premium because the only things that trade off 30% in a short time period are liquid. Everybody hits the ATM. Everybody hits where they can grab the cash. That's where they go. I actually think the more that there is a secondary growth of markets, the more that there's more fund finance growth of markets, the more liquidity there is to things that used to be considered illiquid. We've seen it in the GFC. Some asset classes that people consider liquid, they were highly illiquid. And all of those would get tagged by Basel or by other things as liquid assets. I could have better shot selling a secondary portfolio, even in a very distressed period at a few points off, than I probably could some of those liquid assets. And I think that's a good thing because that creates a much more robust market as we continue to grow, but all things with measure.
I mean, clearly, the evolution of these markets, it's from, your answers and some of the stuff you've been saying, it's clearly made these more resilient over time and certainly back before GFC when it was obviously very concentrated in banks or concentrated in GE Capital or a couple of others. I mean, I would presume that to be the case, right?
Well, I think sometimes when people say, wait a minute, we've seen these geopolitical issues, we've seen these other issues, we've seen type of weakness, and I'm a natural perma bear, and I was talking to somebody a couple months ago as an investor, and it kind of just dawned on me. Of course, I'm a perma bear. I came out in 1997. I dealt with the Asia crisis. I dealt with long-term capital management. I dealt with .com, and then and that was the end of the 90s, and then early 2002, 2003, we ended up having all of our accounting and audited statements were lies. We had WorldCom and Enron, and we had a recession, and we had accounting fraud. And then, oh, by the way, right around year 10 is GFC. That's my first 10 years of my career. So you become a conservative credit guy as you go through those periods. But I think the thing that is really misunderstood is why are we not have as much volatility? We haven't as much volatility because We're not as dependent on banks and systematic risk tied to commercial paper and banks. We do have better liability management. We have less backside leverage. If you look at just the imputed leverage in the system, there's a lot less that's kind of tied to the new growth areas. Your pensions, definitely long-term match others. Private credit, I mentioned, obviously, across that. Even insurance is relatively matched. So you have less of a dependency on the one thing that used to inflate and deflate, inflate and deflate. That's all a cycle is the inflation and deflation effectively of a credit cycle. And so why have we gone through COVID? Even the last 5 years, we've gone through COVID stimulus, interest rates, movements, all of these things have occurred and markets have actually done okay. And the answer is there's no forced selling, right? You don't have this liquidity mismatch because even in the GFC, as much as the history books like to talk about it was all mortgages and everything else, in many ways, it was just forced selling. There was a period there where Goldman Sachs was on the trading block and might go under because there was such contagion. And what happens in forced selling is all of a sudden a correction turns into contagion. And when a contagion happens, all bets are off.
Yeah.
But contagions only happen when it's an unwind of ABS CDOs or SIVs or repo or financing. So when you look at it today, we just saw forced selling. It's called crypto, right? Why did crypto go from $120,000 to $60,000 on a Bitcoin basis? Because there was a lot of imputed leverage actually people were taking, which is scary as anything as a man who does not believe in crypto in any form or fashion. But if you look at that, they had to sell because as the price went down, they got margin calls and there was a lot of backside leverage that was going into those situations.
Yeah.
And that's when all of a sudden something just collapses and you see that collapse overnight. There's not as much systematic risk on forced selling in the system today as there used to be. You can still see it in public equities with margins, and we are definitely at all-time high type margin levels. So that could come back and obviously be a big drawdown in public equities, especially with AI not as a bubble on the fundamental, but a bubble as it relates to valuations.
Before we get to some of the fun questions, I did want to talk a little bit about the promote giving. So you've obviously built promote giving as commitment to allocate a portion of the promote to charitable causes. Where'd that come from, and how does that work within Aries?
Yeah, there was it's been amazing. It's been an amazing journey. I could fill an entire podcast just telling about that story.
Next time.
And one day would love to. Look, if you look at it, I come from, humbler roots. I'm a preacher's kid from Boise, Idaho that didn't know this world existed in any form or fashion. And went to state school, get to be a mechanical engineer and to surf in California. And then, halfway through changed to finance and stumbled backwards into a job at Citigroup that turned into the career that I've been able to have since then. And I've been very lucky and very blessed. And, my parents did raise me right. And, if you have money, give your money. If you have time, give your time. If you can, give both. We didn't have any money, but we definitely gave time. And my dad and my mom was a nurse and my grandmas were both nurses and my aunts were nurses. And there was definitely a spirit of giving back. And it was an obligation to give back and kind of improve the world around you. And I think from that standpoint, when I joined Aries, I had one big ask, which was I wanted to do what I do across, TAC ops and assets and others, as well as have a charitable tie-in. And what we came up with, and Mike Garaghetti, who I've known for 20 plus years now and a very good friend, was very supportive, and all of Aries was very supportive, was this idea, what we did with regards to our Pathfinder family of funds, where we've done 5 to 10% of the promote, half from kind of me and half from Aries, to health and education charities. And it's been amazing because, that little idea and that little ask has turned into something bigger than I ever imagined. It was a percentage of 0 at the time. We didn't have the new funds established and others. And now if you look at it and you look at just the sheer size across what we've been able to do, where there's, $20 billion plus in the Pathfinder family of funds that are doing this. And if you look at last year alone, the grants we've been able to do out of that and the impact you can have for building surgical centers with Mount Sinai and Zimbabwe and doing programs on inline water chlorination in India and doing stuff across what we've done with Educate Girls. And we've done 7 different grants last year. I won't spend time on all of them, but amazing impact where you're truly saving lives and impacting lives. What we've been doing that now for close to 7 years, and it started also the broader Aries Foundation in 2021. So this is the 5th year for the Aries Charitable Foundation, and I co-chair that with Mike Garaghetti and Michelle Armstrong and team run that day to day. And they've done over $60 million of grants having nothing to do with what we've done from the Pathfinder family of funds. So it's been ingrained in our culture now for a while. And it's been part of what we do every day, where when we're doing these investments, we're sitting there having this broader impact, not just on the IRR and the MOIC on the investments, but also the other piece. And about a year ago, the team came and said, hey, what if we get others to do it? Because we've been talking about this for a while. How do we get others to do it? And they made this analogy of, what if we just kept it simple like the Giving Pledge? What if we just got others to pledge to give at least 5% of their promote to philanthropy? And so we launched it with our 8 initial founding signatories. We're working on 5 or 6 others right now, different forms of documentation. We just had actually one new one sign up last week on it. And, it includes Silver Point, it includes Pretium, it includes Pantheon, it includes Macarora, it includes Derby Lane, includes Ascend, includes Pantheon. So some very large organizations that have all agreed to give at least 5% of their promote on their fund or fund series. It doesn't have to be every fund, to philanthropy, whether it's homelessness, whether it's health, education, whether it's housing. Everybody gets to decide where their passion is, and everybody directs their own giving. But you're creating this community to come together, and we do want to make this a thing. We do want others to join us, and would love to hear others who are out there who would look to do this. It's amazing for culture. It's crazy for the impact you can actually drive from this. And in the end, it starts small, but it's that acorn, it's that whole thing of it just continues to grow. And our tagline is compounding purpose. You're just growing the dollars and the impact you're giving the philanthropy. And you totally change the culture on what you're driving for, because you have a dual purpose. You really have a dual purpose of driving the highest returns for your investors, at the same time driving the highest dollars to philanthropy.
So we have just a few minutes left. I like to end with a little fun, some rapid fire questions. So do you have a favorite sports team and/or hobby?
Yeah, anybody who knows me, it's very simple. I grew up on the West Coast. All 5'9" of me loved basketball in every form, played through basketball, played club in college and others. I am a diehard Lakers fan. So it is without a doubt, it's Lakers and then Dodgers across that side of things. And even though I've lived East Coast now for 26 years, I still check in, and Kobe will ever and Magic Johnson will always be near and dear to my heart for the rest of my life.
Tell us one surprise.
Not so much LeBron. I'm still trying to adopt the LeBron as a.
I still think he's by and large Cleveland, even though he had that stop in Miami. But that's
I
just
was rooting against him for so many years that it's kind of hard to fully adopt him as a Laker, as a guy who grew up with obviously Magic and Kobe.
yeah, that's for sure. Tell us one surprising thing about yourself.
Wow, that's a hard one. I will look. I mentioned earlier, I absolutely and totally love to read. I try to get through 30 to 50 books a year. I publish kind of my favorites, not because I'm trying to talk about the books I read, because I'm always looking for new book recommendations. I only read histories, bios, and finance. There's a longer story, which is if you go back to promote giving and kind of my philanthropy tie-in, the other side of it is I should have died 3 times. I had a car accident when I was
Wow.
hit by a car when I was age 7. I was buried alive, longer story, at age 9. And at age 16, I had brain surgery from a car accident where I fell asleep at the wheel and rolled my truck and took out a little corner of my noggin there. So I'm not supposed to be here in any form or fashion. And I think Jeremy Collar has a great quote from Collar, who's one of our initial founding signatories of Promote Giving. When you're 85, I always used to say there's only 3 things that matter: close friends and family, experiences, and did you give back? Jeremy Collar has a better version, which is when you're looking back in your life at 90 or 95, he says he gets a few extra years than I do. When you're looking back in your life, is your 13-year-old self proud of what you did? And is your 90-year-old self proud of looking back at what you've done? And I look at it as my 13-year-old self didn't know this world existed in any form or fashion. My dreams were like down here and I've been able to do things that I never imagined and travel the world and do all these amazing things. But in the end, none of that matters if you didn't do something to give back. If you didn't actually do something to improve the world through mentoring, teaching, parenting, or philanthropy, then you really haven't done anything with your life. And that's really important. It kind of drives me every day, but it also drives me because I shouldn't be here.
What if you had one book, or I guess it'd be hard maybe to do one book, but maybe one recent book that you'd recommend reading, since just 30 to 50 a year.
Dirtbag Billionaire on Patagonia is a great read. I would highly recommend it. And actually, an oldie but a goodie that I had never read, which is Sam Walton's biography, is actually an amazing read on retailing and building a company and a story. And he actually integrates in a whole bunch of his family as well as all of the people around him at Walmart that built it. I honestly always looked at it as this book of like, that's like 20 years old. Is that really worth it? It's an amazing read. I just finished it up. It's called I Am Sam, and it is an amazing, amazing read on. It's almost shoe dog good on Phil Knight's kind of story of telling the Nike story, but kind
Hmm.
of older, so forgotten. And I would highly recommend both of those. And then The Billionaire, who wasn't on Chuck Feeney, who kind of inspired the original Giving Pledge, is an amazing business story on duty-free shops and the growth of that, and frankly, the American dream of coming from nothing and kind of going to college on a GI Bill and giving away 13, $14 billion and starting what is today, General Atlantic. That was his family office. So there's a lot of good ones. I would say look at LinkedIn, and I'm always looking for book recommendations if anybody wants to send me any.
Most exciting part of your job.
I have the greatest job in the world. I will never retire. And it's because beyond the philanthropy thing that gives me the reason I'm doing it, gets rid of the ebbs and flows and the ups and downs. I absolutely, and you probably hear it through some of this, I love investing. I love
Yeah.
markets. I love investing. I love strategy. I love transactions. I was just on 3 calls today going through portfolio and new deals. And there is nothing that gets me more excited than digging into a transaction and figuring out a company and seeing what's going on with the underlying. So I look at it as in life, you always have to have a learning curve. It's kind of like reading. You always have to have that learning curve. There is no greater learning curve in the world than investing. So if you can combine that thing with a purpose, which is to have the philanthropy, greatest job in the world.
And then final question, one prediction for the next 12 months.
Ooh, the two things that have kept this economy going in a very big way are both correlated to each other. One is the AI spend. We're close to $1 trillion, so it's hard to bet against GDP growth when you have a trillion out of a $30 trillion plus economy occurring, and that growth is very real. The downside is it hasn't created a lot of jobs, and it's starting to take away jobs, and it has created a lot of wealth effect. If you look at crypto, if you look at Mag 7 valuations, I think we're a little more tied and correlated to wealth effect than we probably should be. And in the end, that is tied to the valuation of 7 companies, as well as some air people call crypto. And I think that both of those have risks, obviously, if we go through any period of correction where that spending obviously can slow at the same time. So I think we are at a period that's clearly interesting to see and interesting time to be an investor. But I think that those are things to watch.
I have to ask a quick bonus, which is crypto. Why not a
By the
believer?
hater.
Yeah.
And people are always saying, oh, and I remember I was there in the earlier days in my former life with people, and I was the founders of Ethereum would come into our office and others. And so I've been in this world for a long time looking at it. I have two fundamental issues with it. Originally, it was supposed to be processing, hey, this is just a quicker way. And I actually could kind of buy into that idea. If you're paying 7, 8% for money orders or other things, there's nothing in processing about crypto that's cheap. It's a very, very expensive on blockchain. It's very expensive if you look at the cost of energy and other things. Then people have gone to store value. And my main issue on store value is this. Everybody says, well, I say there's nothing backing it. And he says, well, there's nothing backing the US dollar. And the answer is the US could pay off its national debt tomorrow with a few prime sale leasebacks. The US owns more real estate than anybody else in the entire world, and most governments do. There is assets. If you think about it in asset-based finance world, every government has tons and tons of assets. There is nothing backing up crypto in any form or fashion. And when somebody can tell me why it should be worth $70,000 today versus being worth $120,000  2 months ago, and why that they can peg a price, that's where I struggle. And normally people will go to the last, which is gold. And I'll say gold mattered when we actually were pegged. Gold doesn't really matter beyond jewelry either. I don't believe in gold. I look at it as if you have a useful life for a currency or other things, in the end, it's all just that fundamental belief. And I think gold is a leftover from days gone by when we actually had the gold standard. So that's my issue against it. I could be wrong. I look at it as, look, the eighth wonder of the world is compounding. You can't compound zero. You buy assets and cash flow. The rest is noise. There's no cash flow coming off of crypto, and there's no underlying asset that I can see.
I think that's a perfect way to end an asset-based finance podcast. So, Joel, I really appreciate your time. Thank you for spending a few minutes with me. Continued success to you and the team, and obviously to the charitable cause as well.
Thank you for having me. This was a very fun conversation. Appreciate it.
Yep. Thank you. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.